In this video, I'm going to break down the 3 mistakes that most brand new traders make because they're just excited to get into the stock market. Hey, what's up, power traders? Jason Brown here, and I want to talk to you about the 3 mistakes that most new traders make when they're first starting out. Mistake number 1 is picking your trades based on how much money you can make. The reason that this is a mistake is because you come into the game kind of blindsided. And so sometimes people look at, if I buy this and it goes here, I can make a ton of money, but they don't necessarily look at where the stock is at. They don't look at particularly how much overhead resistance there might be where people are selling off at a certain price point. They just know that, hey, I want to make this amount of money and I need the stock to go to here for myself to make that type of money. But they don't really analyze the chart or the stock to say, can it go to that price point? Has it ever been in that price point before? What happens as it gets near or close to that price point? Do people start to sell off? Different things like that. And so if you're not looking at all the components, you're just looking at this arbitrary number saying, I need this stock to get to that number because when it does, ching, I'm going to make a lot of money. It could be a big mistake because you could be overlooking a bunch of red flags. See, mistake number 1, you're just focused on how high something can go and how much money you can make. Well, mistake number 2 is that most people don't look at their trades or their investments and think about how much money can I lose? You can sometimes put yourself in a position where you've put too much money up and haven't thought about the downside of what happens if the stock goes against you. Never put your entire account or entire amount up in a trade that could potentially go wrong and you have no money to trade again for another day. It's a good chance you're also probably not looking at the stock chart and you're probably not determining where support and resistance is at. And you're probably not paying attention to what happens if this thing goes against you. And you're also probably not paying attention to what I like to call your I'm wrong level, which is if it hits this level and I'm wrong, I'm going to get out. But if it hits that level and you're wrong, is that going to be a devastating amount to your account? If it is, you might want to consider doing half the position that you were going to do. You might also want to wait till the stock is closer to support so that it's closer to your I'm wrong level. So if it actually hits the I'm wrong level, you get out with a small loss versus buying a stock at resistance, knowing that it can come all the way back down to support. And if it breaks support, well, you've lost maybe $4 or $5 versus buying it closer to support. And if it breaks it, you lost $1 to $2. Now let's talk about mistake number 3. Mistake number 3 is buying the cheapest stock, or if you're an option trader like me, buying the cheapest option that your money can afford. See, I like to look at the cheapest stock as basically rundown houses. So I live here in Detroit and I look at a cheap stock the same way I look at a rundown house. And that's, yes, you can buy a house for $500 in Detroit, but the type of money that it's going to take to fix that house up, it's going to be astronomical. The type of people that rent that type of house is going to be a totally different class of people with a totally different energy, a totally different set of ethics and morals with respect to maintaining your property. And so I like to look at companies the same way. When you look at companies that are penny stocks or stocks that are under $5, typically they're not in the best neighborhoods. When we put that in terms of the stock market, they're not in the best sectors or the best industries. They typically have poor management or attract poor talent. So the people that work for the companies, the morale can't be too high. Now, not always, but in some cases, the morale of the employees might not be high. So they might not be delivering excellent customer service. Also, the management, right? The people that are running the company may not be doing the best job either, or else they would be increasing market share and increasing the value of the company, and in turn, increasing share price for the shareholders. And so there's a lot of reasons why a stock could be cheap, but some people just go in and says, I bought it because it's cheap. I could afford, I had $100 and it was a penny stock, so I could afford thousands of shares of it. But that doesn't necessarily mean it's the best place for your money to go. Same thing happens with options. Sometimes people look at an option and they'll buy a strike price that is way out of the money. And they'll also not buy enough time for the stock to even get to that price. I once talked to a young lady and I said, it was a stock that was like $50. And on a Wednesday, she bought a call option that expired Friday. And it was 100 strike price. So that meant in 2 days, that stock needed to move about $100. I said, this stock only moves 50 cents a day. Why would you buy 100 strike price option that expires in 2 days? The person told me, well, that was the only option that I could afford. I said, well, it was the last option you can afford because you just donated all your money to the stock market. So cheap is not always better with respect to the stock or with respect to the option. So avoid these 3 mistakes. If you want to learn more about how to pick the right stocks, how to determine the best time to buy and sell, how to develop a comprehensive game plan to have your money work hard for you instead of you working hard for it, feel free to swing by powertradesuniversity.com. Check out some of our free trainings, check out some of our paid programs. We're here to help. I'll see you in the next video.